How does high domestic inflation affect international competitiveness? Imagine trying to sell a product abroad, but suddenly your prices are climbing faster than your competitors. That's what happens when a country experiences high domestic inflation. It might seem like a small change, but it can shake up the entire trade scene. When inflation in a country rises quickly, it pushes up the prices of goods and services made there. If these prices go up faster than in other countries, foreign buyers start looking elsewhere for cheaper options. This means exports from that country tend to decline because they become less attractive price-wise. Meanwhile, imports become more appealing because foreign goods stay relatively cheaper, leading to more foreign products flooding into the country. This can cause the trade balance to worsen, meaning the country imports more than it exports. From a monetary inflation point of view, which focuses on increasing the money supply, high inflation can weaken the country's currency. When there's too much money chasing too few goods, the value of the currency drops. A weaker currency can make exports cheaper in foreign currency terms, which might help some. But this depends on how exchange rates move and whether other countries also have inflation. If the currency depreciates, it can temporarily boost competitiveness. Still, if inflation keeps rising, the costs for domestic businesses go up, making their products less competitive overall. High inflation also raises costs for businesses. When prices for raw materials and wages go up, companies face higher production costs. If they cannot increase productivity enough to match these costs, their prices must go up. That makes their products less competitive internationally. Sometimes, companies try to keep prices steady by lowering profit margins, but if inflation persists, they might be forced to raise prices anyway. This makes their goods more expensive abroad, reducing demand. Another factor is the wage productivity gap. When inflation causes wages to increase faster than productivity, labor costs rise. Higher labor costs mean higher prices for goods and services, which can hurt exports. At the same time, foreign consumers find foreign goods cheaper, increasing imports. This combination worsens the trade balance and weakens the country's economic position. Inflation also influences exchange rates. Countries with higher inflation often see their currencies depreciate because investors lose confidence and move their money elsewhere. While a weaker currency can help exports, it also makes imports more expensive, which can push inflation even higher. This cycle can make it tough for a country to regain competitiveness. High domestic inflation discourages investment too. When prices are unstable, both local and foreign investors become hesitant to put money into the economy. Reduced investment means slower growth and less innovation, which further hampers competitiveness. Central banks may try to fight inflation by raising interest rates, but higher rates can slow down economic activity and make borrowing more expensive. This can hurt businesses that relying on loans to grow or operate efficiently. In the end, high inflation driven by monetary factors tends to weaken a country's international standing. It pushes up costs, reduces demand for exports, and creates economic uncertainty. While currency depreciation can offer some relief, persistent inflation usually leads to a loss of competitiveness, making it harder for the country to grow and maintain a healthy trade balance. Managing inflation carefully and boosting productivity are key to keeping a country competitive in the global market.